Ayuban Puthe, as we promised in the previous video, today also I came with you with Bank of Ceylon to explain another important area in the syllabus. Right. So as we all are aware, why we study? To have a proper job. Right. Why we are doing a job? To earn cash. Cash has a main role in our day-to-day life. Cash has a main role in our day-to-day life. Right? Ultimately, people say everything depends on cash. It says everything depends on cash. So today I thought of discussing with you all another area in the syllabus, unit number 12, statement of cash flows. Unit number 12, we have limited companies. There we have statement of cash flow. And this question in the advanced level examination paper, you have part of a question has been given for 10 marks, but when it comes to 100, 5%. And the MCQ first paper also we have a cash flow question. Right. And as far as Sri Lanka accounting standards are concerned, LK 7 is about statement of cash flows. The purpose of LK 7 is to show or to present the changes in cash and cash equivalents during an accounting period. This is also an integral part or main part of the financial statement presented by limited companies. The statement of cash flows. This statement of cash flows shows the changes in cash and cash equivalent. Shows the changes in cash and cash equivalents. Right. Cash. As per LK 7, cash has been defined. The cash comprises cash in hand and demand deposits. Cash in hand and demand deposits. The cash equivalent, similar item to the cash. The cash equivalent, short-term, highly liquid investment that are readily convertible into cash. Short-term, highly liquid investments. Short-term, highly liquid investment that are readily convertible into cash. So here short-term we identify as 3 months or less than 3 months. Short-term we identify 3 months or less than 3 months. Now the cash flows. The cash flows mean inflows mean receipts and outflows, payments of cash and cash equivalent. The cash flows you define as inflows, receipts and outflows, payments of cash and cash equivalent. Right. And the LK 7, you identify cash flows under 3 headings: operating cash flows, investing cash flows and financing cash flows. Operating, investing and financing. Operating. The operating cash flows are the cash flows, cash receipts and payments flows. Cash flows arising from, the cash flows include both inflows and outflows arising from principal revenue producing activities. The principal revenue producing activities. The investment activities, investing activities mean the cash flows, acquisition or disposal of long-term investments and other investments. Acquisition and disposal of long-term investments and other investments which is not a part of cash equivalent. Say fixed deposit is an investment. But in the cash flow preparation, if the fixed deposit is for a period of 3 months or less than, it's a part of cash equivalent. If your fixed deposit is for a period of 3 months or less than 3 months, it's a part of your cash equivalent. But it goes more than we call investment. Then the finance in cash flows. Finance in cash flows. The cash flows that change the size and the composition of equity and borrowings. The cash flows that change the size and the composition of equity and borrowings. Right. And in the classification of cash flows, we have to identify the nature of the business. We have to identify the nature of the business. Example, say garment factory purchases a motor vehicle to deliver garments. A garment factory, they purchase a motor vehicle for delivery of garments. Then for that garment factory, that motor vehicle is an investment, non-current assets. Non-current asset. But vehicle trading company, a vehicle trading company purchases a motor vehicle for resale purpose. For resale purpose. That is their operating activity. Another example, say a company purchases land. A company purchases land to construct its head office. So that land is an investment, non-current asset. But real estate company or land sale company, the land sale company purchases some land for resale purpose. For resale purpose, then it's their operating activity. And then when you go to your financial statement, if you take your financial statement, statement of financial position, you have non-current assets, current assets, equity, non-current liability and current liability. These are the main 5 elements in a statement of financial position, the 5 elements. In these 5 elements, non-current assets is an investing activity. It's very easy to keep in mind, investing. The current assets, current liabilities, your operating, day-to-day operating activities. Then the equity part is your financing activity. Financing activity. It's easy to keep in mind. It's easy to keep in mind. Non-current assets is your investing. Current assets, current liabilities, your operating, and non-current liabilities and equity. Non-current liabilities and equity are your financing activities. That's how you can keep in mind easily. Investing, current liabilities, current assets, operating, and non-current liability and equity part goes to your financing activities. Financing activities. We'll discuss questions now from the statement of cash flows. So, question number 1. An item which cannot be treated. An item which cannot be treated as cash and cash equivalent. And how you define the cash? The cash comprises of cash in hand and demand deposits, cash at bank. Equivalent, the short term highly liquid investment. The bank overdraft is your part of your cash. Bank overdraft is part of your cash. Then the petty cash is a part of your cash. Petty cash is a part of your cash. Then the 3 months treasury bills. The 3 months treasury bills is your part of your cash. 3 months is part of your cash. The short term deposit is also part of your cash. And that treasury bonds is your investment. The bank overdraft is part of your cash, petty cash balance part of your cash, treasury bills part of your cash equivalent, and short term deposit part of your cash equivalent. Bank overdraft, petty cash part of your cash. Why the question was cash and cash equivalent. First two cash, second two cash equivalent. Answer number 5. The answer number 5. The question number 2. Which of the following should not be included in part of cash? Should not be included. Should not be included. The petty cash. The petty cash we include as a part of cash. Unused overdraft facility. Unused overdraft facility. It is not an overdraft, unused overdraft facility. Now say you get an approval for overdraft facility. The overdraft facility you don't have a double entry. Now say 500,000. You get the approval for 500,000. The overdraft is a facility. 500,000. The until you used, it's not a liability. Now say example, you get the permission from your bank branch to use a facility of 500,000. The until you use, you don't have a liability. So here it says unused overdraft facility. Now say example, to your cash account, bank account, to your bank account you have balance of 100 rupees. For that you get an overdraft facility of 500,000. This is facility 500,000. So no double entry. If you issue a check, say for 120,000, you issue a check for 120,000. You had 100 in the bank, you use a check for 120. You use a check for 120, then that is here have an overdraft of 20. Overdraft. Now, what's your overdraft facility? So, what's your overdraft facility? Facility is 500,000. How much you used? You have used only 20,000. This is the amount you have used. This is the amount you have used. Out of 500,000, you have used only 20,000. Then this 20,000 you can identify as a cash equivalent. But what's the question? What's our question? Unused overdraft facility is not a part of cash or cash equivalent. The check received we take as a part, correct? You have received the check, again you have received the check, here again check received. That's the answer, unused overdraft facility. Until you use, it's not your part of your cash. Until you use, it's not a part of your cash. So question number, question number 2. So our answer will be the second question you can mark as the answer number 2. Answer number 2. And here I explain you how your overdraft become a liability. Now for this account, again I am revising you 500,000 overdraft facility, but you use only 20,000. Unless you use, it's not a liability. Until you use, it is on liability. The answer, number 2 for the question number 2. So question number 3, which of the following increases net cash flows from operating activities? Increases operating activities. Increases operating activities. We'll take first one. Increase in inventories. Inventories increase mean cash outflow. Cash outflow. No? Cash outflow. Increase in trade payable. The trade payable liabilities increase mean you haven't settled. The liabilities increase mean you haven't settled. Cash inflow is a cash inflow from operating creditors, a part of your current liabilities operating. The receipt of bank loan, the bank loan is a financing activity. Sale of non-current assets, again financing, so investing activity. Interest received from fixed deposit, investing activity. The first one, inventory increase mean you have purchased, cash outflow. Increase in trade payables, increase in trade payable. In payable liabilities increase mean you haven't settled. The liabilities increase mean you haven't settled. Inflow operating activities. The bank loan financing, non-current assets investing, fixed deposit investing. The fixed deposit investing. Then the answer is answer number 2. The answer number 2. The answer number 2, increase in trade payables. Increase in trade payable. Liabilities increase, you haven't settled. Liabilities increase, you haven't settled. Trade payables, creditors, liabilities. The few cash flows of an entity are given below. Cash flows of an entity. So select the answer which has classified the cash flows correctly. Operating, investing, financing. Operating, investing, financing. The cash sales. The cash sales, day-to-day activity, operating. Cash receipts from customers. The customers you receive, day-to-day activity, operating activities. The payments to creditors. Here the question is cash flows. Cash flows include both inflows and outflows. The creditors also operating. Operating. Disposal of non-current assets. Non-current assets is your investing. Non-current assets are investment. The purchase of long-term investments. Investing activities. Right. Share issue. Share issue is a part of equity. It's a financing activity. The redemption of debentures. Debentures, non-current liabilities. Redemption, you pay their cash back. Then it's a financing. Will leave interest paid. The payment of dividend. You pay dividend. Why you pay dividend? As you have issued shares. Financing. Financing. Payment of income tax. Operating. You earn profit. Profit is your operating activity. Then you pay taxes. Interest paid. Interest paid. The payment of interest. The interest payment. And the interest you pay for loans. The interest you pay for loans. And when you are settling your loan installment, say loan installment say 500, installment is 500. So this include 425 rupees of loan repayment and 75 rupees of interest. When you settle your loan installment, it includes loan of 425, 75. Then when you are classifying this, the loan portion you must calculate, you classify as a financing activity. Capital repayment, you should classify as a financing activity. But interest payment, you may classify as operating or financing. Interest component of 75, you may classify under operating or financing activities. Then you can go to the question, interest payment. Interest payment is H. DE investing. The DE investing. Then this answer. Second answer, third answer, fourth answer also have. FIJ, so FJI, a financing activity. FJI, a financing activity. Then interest is the case. Interest has been classified under operating activities. Answer number 1. Answer number 1. The question number 4, answer number 1. Fourth question, answer number 1. This company has obtained a motor vehicle 1 million and paid 250,000. They have paid 250,000 as lease installment. Lease settlement. The lease liability you record under liability section. Lease liability, the liability section, and you have paid is an outflow. Lease installment, lease is a financing activity. Lease is a financing activity. Then you record this under financing activities 250,000. 250,000 financing activities. Answer number 5. The answer number 5, fifth answer. And you have information to calculate cash flow. You have to calculate cash flows under investing activities. The profit or gain from disposal is given as 3,000. Disposal gain is given as 3,000. And the accumulated depreciation and the cost of this asset given. The easiest way, you can prepare a disposal account. You can prepare a disposal account to get the disposal profit or loss. It's a furniture, or you can prepare the furniture disposal account. You can prepare the furniture disposal account. Furniture disposal account. In the disposal account, we record mainly 4 entries, including disposal gain or loss. And you debit cost of the asset. You debit cost of the asset. And these are not the proper double entries. I am just showing you the disposal account. Cost of the asset, and the accumulated depreciation or provision for depreciation, selling price, cash. And I emphasize you, these are not the other accounts name. In the ledger account, you write usually opposite account: cost of the asset, accumulated depreciation, selling price. And in this question, according to our question number 6, is a disposal gain. If it is a disposal gain, you credit your income statement of profit or loss or income statement. The disposal profit or gain from disposal is 3,000. Disposal gain is 3,000 rupees. We do in thousands, 3,000. And the accumulated depreciation is 1.5. Then the cost is 8,000. The cost is disposal gain. The disposal gain is given as 3,000. The disposal gain is 3,000. Here put the disposal gain 3,000. Cost of the asset is 8,000. The cost is 8,000 rupees. Then you have to calculate what is the cash selling price mean here. Cash. You can balance this account and get the answer. 8 plus 3. 8 plus 3, 11. You can write it here. 11. 8.51. The cash received is it's 9.5. The cash received is 9.5. Difference to 9,500. Cash received 9,500. Disposal account, you calculate the missing value. Disposal gain, if you want again the disposal account, cost, provision, disposal gain, and the difference is cash received. The answer number 1. The answer number 1, we have received cash 9,500. The cash received 9,500. So, question number 7, what is the change in working capital? So, what is the change in working capital? The working capital. In financial accounting, the difference between the difference between current assets and current liabilities we identify as working capital. The difference between current assets, so working capital equal current assets minus current liabilities. The working capital equal current assets minus current liabilities. Right. The question is, what is the change in working capital based on following information? Right. So how can we calculate working capital? Current assets minus current liabilities. Right. We will take one by one. Inventories. Question: increase in inventories. The inventory increase. Inventory increase. The inventory increase mean what happens to current assets? Current assets increase. Then working capital also increase. The current assets increase mean working capital increase. The decrease in bank balance. The bank balance decrease. The bank balance decrease mean your current assets decrease. How much? 800. 800. Increase in trade payables. The trade payables increase. The trade payable increase mean your liabilities increase by 240. Your liabilities increase by 240. Again, working capital means current assets minus current liabilities. The working capital means current assets minus current liabilities. Inventories increase by 500 mean working capital increase. The bank decrease 800, current assets decrease. Then increase in trade payable increase mean liabilities increase. So you can get the net amount. The 500 minus 800 you get 300, plus minus become minus 240. 500 minus 800 again it becomes minus 300, and you can identify the answer. Minus 300 minus 240 to minus 540. So working capital decrease by 540. Working capital decrease by 540. The working capital means current assets minus current liabilities. It's decreased by 540. Answer: decreased by 540. Answer number 3. A decrease of 540,000 rupees. The requirement is, what is the net profit earned by the company for the year ended? Do you have this is a newly started business. And so there are no opening balances. Property, plant and equipment inventories, debtors, creditors, other information. Depreciation given as 50,000, net cash flows generated from operating activities is 600,000. What's the profit? So as you have learned, here we can calculate indirect method cash flow calculation. You can calculate the profit as the opening. The profit, you can make a backward calculation. Net cash flow is given. The net cash flows from operating activities the given. The net cash flows from operating activities 600,000. You can make a backward calculation to get the profit. The main adjustment, the question requirement is to calculate the profit. You can remember the indirect method. For the profit, you make the adjustments, then working capital changes, interest paid, tax paid, you get net operating cash flows. Net operating cash flows. Net operating cash flows. The net operating cash flows given as here given as 600,000 rupees. Given as 600,000 rupees net operating cash flows. Right. The property, plant and equipment. Property, plant and equipment is an investing activities. Here we don't consider inventories. And the question clearly mentioned this is newly started company. The question clearly mentions a newly started company, no opening balances. The inventories increase. Inventories increase by 450 means 350 mean cash outflow. Cash outflows. Inventories increase mean you have purchased inventories. Cash outflow. Debtors, trade receivables. The debtors increase. Why? No opening balances. Debtors increase mean cash outflow. Debtors increase mean cash outflow. Then the creditors 50,000. The creditors also increase. The creditors increase by 50,000. Creditors increase mean you haven't paid. You have not paid. You have not paid means cash inflow. Right. Then the depreciation given. Depreciation you record under adjustments. Depreciation 50,000. Depreciation 50,000. The net operating cash flow you have 600,000. Changes in working capital. Inventories increase. Debtors increase cash outflow. Creditors increase cash inflow and depreciation of 50. If you take here this net amount comes to 200 minus, then you can calculate how much is it. You can calculate 600 x minus 200 is equal to 600. Here should be 800. To get 800, how much is the profit? How much is the profit? Profit is 750. 750,000 is the profit for the year. What you did here, you make a backward calculation. You make a backward calculation to get the profit. Profit is 750,000. 750,000. Answer number 1. First answer. To get the calculation, what we did, operating cash flows, you make a backward calculation. Using net operating cash flows, you calculate the profit. Answer number 1. the question requirement, the net cash flows from operating activities, net cash flow generated from operating activities. The previous question net cash flows was given. Net cash flows was given. Now here we had to calculate profit. Now the profit is given. We have to calculate the net cash flows. This again you can identify this is a newly formed company, newly started company. Right. And you can use the same calculations. And here you make the adjustment, then working capital changes, and finally you get net operating cash flows. The net operating cash flows here you can separately deduct income tax and interest. You can deduct separately income tax and interest. The company's profit. The company's profit is 250,000. We'll do in 1000. 250,000 is the profit. The total assets given. And if you look at this equipment, the cost of the equipment is 640. Now it has become 600,000. 640,000 worth of equipment has reduced to 600,000, which is your depreciation. The reason is depreciation 40,000. The depreciation 40,000 rupees is your depreciation. Right. So the depreciation we record under adjustments. Depreciation you record under adjustments for the depreciation. Depreciation we have deducted in the profit, we have to add it back. Accrual basis profit, we have deducted depreciation, we have to add it back. Depreciation was 40,000 rupees. Then equipment we considered. Inventory. The inventory, this is a newly started business. Newly started business, no opening inventory, then the inventory has increased. You record under changes in working. Inventories increase. The inventories increase means it's a cash outflow. It's a cash outflow. Then you have cash balance. Cash balance we take as a part of cash and cash equivalent. So then you can calculate profit 250 plus the 290 minus 200, answer is 90,000 rupees. 250 plus 40, 290 minus 200, the answer is 90,000 rupees. The 90,000 is the answer. The answer number 3, 90,000 rupees. 90,000. A company which form on trust April reported profit of 500, the profit. Right. The profit is the final value after deducting tax, interest, everything, profit. The details given. Income tax payable, this tax payable 1100. The tax payable, machineries, inventories, cash and bank, trade payables, and income tax payable is 1100. The tax paid was 900. The tax expense how much? Tax expense, the paid plus payable. Expense, paid plus payable. The payable how much? 900. Sorry. Paid 900, payable 1100. Addition of these two come interest expense. Interest expense is 2000 rupees. Interest expense. Tax expense is 2000 rupees. Machineries, the machineries cost 9700, accumulated depreciation 9700, but the value carrying amount is 9100, so it's depreciated by 600 rupees. The depreciation 600 rupees. 9,700,000 worth of machineries, now 9,100, depreciation is 600. The inventory is cash, trade payable. The question requirement, what was the operating profit before working capital changes? Operating profit before working capital changes. Right. And then our calculations, in our calculation, if you consider these in detail, you get profit, the profit, and here profit before tax. Usually we take profit before tax. Profit means profit before tax. But if you take our example, this given profit, the profit means after tax. Profit means after tax. Here the profit cash flow we take before tax. You take profit before tax. Why? The tax we separately adjust. Profit before tax. Right. How can you calculate profit before tax? How can you calculate profit before tax? Profit is given 5,700. The profit is given 5,700. It is after tax. It is after tax. Profit given as 5,700 after tax. Then you calculate before tax by adding tax expense. Expense how much? 900 paid plus 1,100 payable. Tax expense is 2,000. Tax expense is 2,000. So you get profit before tax as 7,700. 7,700. 7,700. The question requirement is operating profit before working capital changes. Operating profit before working capital changes. Here we are just in the working capital changes. Before working capital changes. Before working capital changes, the value here. Value here. Right. To calculate the profit before tax, you have 7,700, then you make adjustments. So what are the adjustments we have? Only the depreciation. Only the depreciation. So how much is the depreciation? Depreciation 9,700 has become 9,100. Depreciation is 600,000. Then you get profit before working capital changes 8,300. 8,300. This is called operating profit before working capital changes. The operating profit before working capital changes. The answer number 2, 8,300. Answer number 2, 8,300. Operating profit before working capital changes. Operating profit. Answer number 2. To question number 11, the net profit after tax. The profit after tax is 95 million. Depreciation, investment income, salaries and wages, income tax for the year, tax paid during the year. The cash generated from operations that should be shown based on the above information. Based on the above information. The profit after tax is given. The profit after tax is given. Depreciation, investment income, salaries, wages, income tax for the year. Tax for the year. The tax for the year means expense. Tax paid 7,500. The requirement is cash generated from operations. Then we can use the same calculation sheet. Same calculation sheet we can use, and they are given. They have given profit after tax. The after tax is 95,000. The after tax is 95,000. Here we take before tax. Then you add tax expense. Then you add your tax expense. The tax expense means tax for the year. Tax expense means tax for the year. It's 8,000. 8,000. 95 plus 8, 103,000. 103,000. The depreciation for the year. The depreciation for the year is an adjustment. In the accrual basis profit, depreciation you have deducted. Depreciation you have deducted. Accrual basis profit. How much is it? Depreciation is 5,000 rupees. 5,000 you have deducted. We have to add it back. We have to add it back. Then investment income. Investment income, how much? 2,000. This is another income. Investment income you have recorded under other income, which is a part of profit. But you get investment income as you have invested. You get investment income as you have invested. It's an investing activity. You have to take it out. Investment income, how much? 2,000. Investment income, 2,000. Then the salaries and wages, normal transaction we don't consider, tax we considered. There are no other information to be adjusted. You can get the answer. The answer is 106,000 rupees or 106 million rupees. 106 million rupees. Again, the answer. Profit was given, for that you add tax and you got the profit before tax. We had depreciation and investment income deducted, 106,000. The answer number 4. The 11th question, 4th answer. The 11th question, 4th answer. The 12th question, following information for the year, what is the value of net cash flows from operating activities? The profit for the year is given, depreciation, machinery disposal loss, increase in working capital. Increase in working capital. If the working capital means current assets minus current liabilities. Working capital means current assets minus current liabilities. Increase in working capital. Increase in working capital means current assets must have increased. Current assets must have increased, which is a cash outflow. Or current liabilities must have decreased. Current liabilities must have decreased. The liabilities decrease means you have settled your liabilities. You have settled your liabilities. That's a cash outflow. Increase in working capital increase means cash outflow. So you can use the same calculation sheet. So question number 12, same calculation sheet you can use. The net profit for the year. Net profit for the year, no information on taxation, you can take as it is 70,600. 70,600. Depreciation for the year. Depreciation for the year. The accrual basis profit, depreciation we have deducted. To convert into cash, you have to add depreciation. The machinery disposal loss, this is depreciation. The machinery disposal loss. The machinery disposal loss is a disposal transaction, investing activity. Disposal loss you have deducted from the profit. You have to add it back to disposal loss. How much is it? 1,900. 1,900. Increase in working capital. The increase in working capital, I explain you here. Working capital increase means either current assets increase or current liabilities decrease. Both are cash outflows. The working capital decrease. How much? Changes in working capital. The working capital increase 14,300 mean cash outflow. Working capital increase mean cash outflow. So you can get the total. The 78,300 net operating cash flows. 78,300, 78,300,000. The answer number 3, 78,300,000. 300,000. So what we did? Profit, we make two adjustments and deducted the working capital change. Answer number 3. The following financial statement extract for the years 2020 and 2021. The profit before depreciation, is a good point. It's given as profit before depreciation, but depreciation also given. And as the profit before depreciation given, this depreciation no need to consider. No need to consider. Why? The profit before depreciation is given. The profit before depreciation is given. The inventories, debtors, creditors. What is the operating cash flows for the year ended? Operating cash flows for the year ended. Right. Then we can use our previous calculation sheet. The question requirements you to calculate the operating cash flows. The profit was given as 1220. Profit was given as 1220. And the profit is given before depreciation. Before depreciation, then no need to consider depreciation. Depreciation no need to consider. Inventories, debtors and creditors. Inventories, debtors and creditors. Inventory to last year 55, this year 68,000. Inventories increase. Cash outflow. Cash outflow. Debtors last year 43, this year 35. Debtors they have decreased. Cash inflow. The creditors last year 59, this year 47, you have settled cash outflow. Inventories you have purchased outflow. Debtors they have settled inflow. Creditors decrease, you have settled them cash outflow. Under working capital changes, you can adjust them. You can adjust them under working capital changes. The inventories, cash outflow of 13,000. Debtors, cash inflow of 8,000. Creditors, you have settled cash outflow of 12,000. Creditors. It should be under working capital changes. It should be under working capital changes. But here no adjustments. No adjustments. This should be under working capital changes. This should be under working capital changes. Working capital changes. No adjustments to be made, but you have a doubt. Depreciation is given. Why? Depreciation is given. but as a profit before depreciation given, then no need to consider depreciation. You can get the answer. 1220 minus 13 plus 8 minus 12, you get 1203. 1203. The answer number 1. The answer number 1. 1,203,000. 1,203,000. The following information for a company: net profit for the period. So when you have net profit for the period means you have deducted your interest and tax. And why we consider these interest and tax always? Those are separate line items in the cash flow. Tax paid, interest expense, the provision for income tax as at 31st March. The tax provision means payable. Tax provision means payable. However, there was no under or provision for the previous year. The question is, what is the profit before interest and tax? The profit before interest and tax. Profit before interest and tax. We will make the calculation. To question number 14, the question requirement is profit before interest and tax. The profit before interest and tax. The profit was given. The profit was given as, how much is the profit given? The profit is given as 2000. The profit means after all tax and interest, everything. Then you minus tax expense. You have to minus tax expense. You have to minus tax expense. The question was before interest and tax. Then you minus interest. Then here you get profit before interest and tax. The tax expense. The expense equal here the paid plus payable. Paid plus payable. Tax paid how much? 300. The payable means provision 200. Tax expense is 500. If the tax paid 300 here and payable 300 paid, 200 payable, altogether 500. Expense is 500 be recorded. So here you get before tax, profit before tax 2500. The profit before tax 2500. Then interest. The interest expense given, it no issue, it's an expense given, interest expense 500. The interest expense given as 500. Interest expense given as 500, this expense fully expense, no issue, 500. The interest expense is 500. You can calculate the profit before interest and tax. 3,000 is profit before interest and tax. The answer number 5, 3 million rupees. You make a backward calculation here. You make a backward calculation to get the answer. You made a backward calculation to get the answer 3 million rupees. Answer number 5. To use the following information to answer question number 15 and 16. A company which was formed on 1st April, newly started company, reported a profit of 6.3 million. Right. The machineries cost 4,600,000. Machinery value is now has become 4 million. So you have depreciation of 600,000. We have depreciation of 600,000. Inventories increase, cash and balance, trade receivable and trade payable. The income tax payable 1,500 was paid. And you can get tax expense. You can get tax expense 1,000 plus 1,000 plus 500. 1,500 is the tax expense. The tax expense is 1,500. These are the basic details. You identify two important points. Depreciation is 600, tax expense 1,500. The requirement. So what was the operating profit before working capital changes? Operating profit before working capital changes. The indirect method calculation. The question requirement is to calculate the operating profit. We take the summary again. The profit, this is before tax, profit before tax. You have adjustments and you get before working capital changes and changes in working capital. The working capital changes. Then you have interest and income tax to get net operating cash flows. The question here is to calculate this value. This value is what? Operating profit before working capital changes. Before working capital changes. Before working capital changes. Operating profit before working capital changes. In the question, the profit was given. Profit was given 6,300,000, but here we take profit before tax. Here we take the profit before tax. Then the tax expense we have to add to get the profit before tax. Tax expense you have to add. Tax expense. The question information. It's paid 500, payable 1,000, expense is 1,500. Expense is 1,500. Then before tax will be 7,800. The before tax is 7,800. How you get 7,800? 6,300 plus 1,500, 7,800. 800. If there is an adjustment, we had only one, which is depreciation. Depreciation, how much it was? Machinery's cost 4,600,000 has become now 4 million. Depreciation 600,000. That was the only adjustment we have. Profit for the year. This addition before tax 7,800 plus 600, 8,400 rupees. 8,400,000 rupees before working capital changes. So before working capital changes, profit is 8,400,000 rupees. Answer number 3, third answer. What was the net cash flow generated from operating activities? Generated from operating activity, net cash flow. Operating activities. So we can continue the same calculations. Working capital changes. Working capital changes. Inventories. Changes in working capital. Inventories. And the inventory increase in inventories 1,300,000. Why? This is a newly started company. Inventory value increase mean cash outflow. The trade receivables also increase. Trade receivables also increase by how much? 1,300. Trade receivables. The trade payables 1,400. Trade payable increase mean cash out, cash inflow, cash inflow. Then the tax payment also here, we have tax payment. Tax payment you separately adjust. Tax paid. Tax payment was 500. The previous question we calculate operating profit before working capital changes. Changes in working capital. The changes in working capital. After adjusting that, you get 7,200 minus 500. This is the net operating cash flow 6,700. The net operating cash flows 6,700,000. 6,700,000 is the answer. Previous question we calculate up to operating profit before working capital changes. Changes in working capital minus tax payment, you get the answer. 6,700,000, answer number 3. Third answer. The following information of a business is relevant for the year. The cash paid for acquiring non-current assets. The cash paid is an outflow. The cash payment is an outflow. Non-current assets is an investing activities. Investing activities. Right. The decrease in working capital. Working capital decrease. The working capital equal current assets minus current liabilities. The working capital decrease mean either current assets decrease or current liabilities increase. The decrease in working capital may be current assets decrease or current liabilities increase. Decrease in working capital means current assets minus or current liabilities increase. The current assets decrease mean cash inflow. Cash inflow. The current liabilities increase, also cash inflow. Current assets decrease mean cash inflow, current liabilities increase, also cash inflow. Increase in bank balance. The net profit of the business. You have to calculate the net profit of the business. Using cash flow calculation, we can make these calculations. Using our normal cash flow indirect method summary, we can make these calculations. And I'll use the same sheet this side. The cash paid for non-current assets. The non-current assets cash payment is a cash outflow. Don't consider this side, only the calculations. The question number 17. Question number 17. The cash paid for non-current assets. The non-current assets investing activity 800 outflow. Decrease in working capital. The working capital decrease mean decrease in working capital may be due to decrease in current assets or increase in current liabilities. Working capital decrease may be due to decrease in current assets or increase in current liabilities. Both are cash inflows. Both are cash inflows. How much is it? 1,200. Cash inflow. Here we are calculating cash flow. Increase in bank balance. The cash flow operating plus investing plus financing. Operating plus investing plus financing. This is called net change. Net operating, net investing, net financing we call net change. And then finally you get net change. How much is it? 1,700. 1,700. Then how much is the profit? The profit is the missing value. The net operating, net investing, net financing, what we calculate? Net change. So what we calculate? Net change. Net change is given as 1,700. Now what's the missing value? What is the missing value? missing value is profit. Missing value is profit. So you can calculate, say the profit is x plus 1200 minus non-current assets purchase should be equal to 1700. Should be equal to 1700 into x plus 400 equal 1700 x 2100. So what we did here, the cash flow summary. Cash flow summary. It should be equal to 1700. The answer is missing value. You take the other side, small mistake here, it becomes 1700 minus 400, 1300. So what we did here, operating profit, working capital, cash flow summary, the indirect method summary, 1,300,000 rupees. The answer is here 1,300,000 rupees. The answer number 3, the third answer. So question number 18. The cash generated from operations that should be shown in the statement of cash flows for the year ended. So here given profit after tax, depreciation, investment income, salaries and wages, tax for the year. The requirement is the cash generated from operations. The cash generated from operations. Right. They can use the same calculation sheet. The net profit after tax is given. So here you have net profit after tax. Net profit after tax, we take here profit before tax. The after tax how much? 18,000. The after tax 18,000. Tax expense you have to add. So how much tax expense? Tax expense 8,000. You add, then you get 26,000 profit before tax. The depreciation for the year. Depreciation, non-cash expense, you have adjusted to the profit, adjustment deducted, you have to add it. How much is the depreciation? 5. The investment income. The investment income, you have already added investment income. How much? 2,000 you have already added, now you deduct. The salaries and wages normal transactions. Salaries and wages, the normal transaction, we no need to consider. The cash generated from operations, the no information on working capital, the cash generated from operation is 29 million rupees. 29 million rupees. The answer number 29 million. The answer number 3, cash generated from operations. The cash generated from operations. To define following as per LKS 7. The LKS 7, account stand number 7 is applicable for cash and cash equivalent. Cash at the beginning of the lesson also I define cash. The cash comprises cash in hand and demand deposits. The cash in hand and cash at bank money. The cash comprises cash in hand and cash at bank demand deposits money. Right. The cash equivalent, short term highly liquid investments. Short term highly liquid investment that are readily convertible into cash, known amount of cash. Short term highly liquid investment that are readily convertible into cash, known amount of cash. The example, short term investments, short term treasury bills, savings accounts money we take as cash equivalent. Here short term means 3 months or less than 3 months period. To define investment activities as per LKS 7, the investment activities. Now, if you take the financial position, if you take your financial position, it's easy to keep in mind the financial position you have mainly 3 non-current assets, current assets, equity, non-current liabilities, current liabilities. Here non-current assets are investing activities. The current assets and current liabilities are operating activities. Equity and non-current liabilities your financing activities. Easily you can remember, you can keep in mind where you record. If it is non-current assets, investment, current liabilities, current assets, operating, equity and non-current liabilities, financing. Then the question is investing activities. Investing activities is non-current assets. Then how you define it? The acquisition and disposal of long-term assets and other investments which are not part of cash equivalent. Not part of cash equivalent. So what does it mean if you take if you take investments, now say fixed deposit, say 3 months or less than fixed deposit, and you have another fixed deposit, one financial year, one annual fixed deposit. Under the cash flow classification, this fixed deposit in 3 months you record as a part of your cash equivalent. You take as a part of your cash equivalent, but annual 1 year fixed deposit you record as your investment, investing activities. That's the difference. If the fixed deposit is for 3 months, part of your cash. If it goes more than 3 months, part of your investing activities. Investing activities. Investment activities as per case 7, acquisition and disposal of long-term assets and other investments which are not part of your cash equivalent. Indicate whether each of the following cash flows is classified under operating, investing, financing. Right. And the easily you can remember, keep in mind that the non-current assets current assets, equity, non-current liabilities, current liabilities. This is investing, operating, financing. The loan recoveries from the employees, To recover loans, you must have granted loan. The loan granted by this company is an investing activities. It's an investing activity, non-current assets. Should be investing activities. Investing activities. The purchase of plot of land by a land sale company. By a land sale company. The land sale company's lands are their inventories. So usually normal companies say garment factory purchase the land to construct its factory. That's their non-current assets investment. But land sale company, they are day-to-day operating activities. Operating activities. The salaries paid to the workers who construct the office building. You have paid the salary to for what? To construct the office building. You have paid salaries to construct the office building. Office building is a non-current assets investing activity. Investing. The proceeds from the sale of motor vehicle by vehicle selling company. Proceeds means the receipts from sale of motor vehicle by a vehicle selling company. That's their day-to-day activities, operating activities. Operating activities. Investing, operating, investing, operating. Here it's a land sale company. This is vehicle selling company, day-to-day operating activities. Loan recoveries, investment. Land sale company operating, salaries paid to workers who construct the office building, invest in. The receipts from motor vehicles, operating activities. Identify whether it's operating, investing or financing. The cash sales. The cash sales is your operating activity. The cash sales is your operating activity. The receipts from credit sales. Receipts from credit sales, operating activity. The disposal of non-current assets. Disposal of non-current assets. You can remember here non-current assets, investing activity. The non-current assets, investing activity. The non-current assets is an investing activity. The rights issue of shares. The rights issue of shares, your financing activity. The rights issue where you record share issue is equity. Equity is your financing activity. Equity is your financing activity. Right. Operating. Receipts from credit sales, operating, investing, finance. Again, to classify cash flows, the settlement of amount due from customers of goods. Settlement of customers due from customers, your customers day-to-day activity, operating activity. The payment of annual loan installments. The loan, your non-current liability. The loan is your non-current liability. It's a financing activity. Financing activity. The receipt of dividend. You receive dividend. Why you receive dividend? You receive dividend as you have invested. You receive dividend as you have invested. Invest in activities. The purchase of a land on cash. Land is your investing activity. Land is your investing activity. Settlement of amount due from customers, they operating. Payment of annual loan installment. Loan is a finance, non-current liabilities. The receipt of dividend, you receive dividend as you have invested. Purchase of land, non-current asset. Land is a non-current assets, investing activity. To question number 24. classify the cash flows of a trading company. The trading company, they are buying and selling. The settlement of loans by employees. Settlement of loans by employees. For them to settle, you must have given loan. If you have given loan, where you record non-current assets. It's an invest in activities. It's an invest in activities. Invest in activities. The redemption of debentures. You issue debenture. You issue debentures to raise capital. You issue debentures. Debentures, where you record. The debentures you record under non-current liabilities. Debentures, non-current liabilities. The redemption mean you give their cash back. You are redeeming debentures. You are giving their cash back and taking back debentures. So, financing outflow, the financing activity. The payment to employees who construct the office building. Payment to employees construct the office building. These employees, they have constructed the building, not day-to-day operating activity. Construction of building is an investing activity. Investing activity. The purchase of debentures from the share market. Purchase of debentures. You purchase debentures from the share market as a part of your investment process. As a part of your investment process. So, purchase of debentures, investing activity. Investing activities. Settlement of loan by employees, investing. Redemption of debentures, financing. Payments to employees who constructed the building. They constructed the building, investing. Purchase of debentures, also an investment activity. The state two methods that may be adopted by a company to issue new shares to whom? To the existing shareholders. To issue shares to the existing shareholders, company have two methods. You can make a rights. You can go for a rights issue, or you can capitalize your reserves, capitalization or bonus issue. The capitalization. Right. These are the two options available. You can go for a rights issue and you can capitalize your reserves. You can go for a rights issue and you can capitalize your reserves. The rights issue, what's a double entry? If you take a rights issue, what's a double entry? In the first one, double entry, cash control account debit, cash debit, stated ordinary share capital account credit, stated ordinary share capital account credit. Right. When you make a rights issue, you get cash account debit, stated share capital account, ordinary share capital account credit. The cash debit, cash flows. What will happen to your cash? Cash debit, cash inflows, cash flows, increase. This is the cash account, asset account increase. The stated ordinary share capital is part of your equity. Stated share capital is part of your equity. Owner's equity. Credit means equity also increase. When you make a rights issue, you get cash control account debit, cash flows, cash increase. Credit entry goes to statement of credit entry goes to stated share capital account credit. Stated ordinary share capital account credit is a part of your equity. The capitalization. So what's the double entry for capitalization? Capitalization. Whatever the reserve you use, debit. The reserve account debit. Reserve account debit. Stated ordinary share capital account credit. Reserves account, when I would say you are using your revaluation reserve, you use your revaluation reserve. Revaluation reserve account debit. Stated ordinary share capital account credit. The cash, the no increase in the cash control account, you can write no change, or you can put dash, no change or dash. Then the reserve is a part of your equity. Reserve is a part of your equity. Equity increases. Sorry, reserve you debit, equity decreases. Equity reduce. Equity reduce. As you debit or as you take money from a reserve, reserve decrease. The stated ordinary share capital credit. Stated ordinary share capital credit means your equity increase. Here equity decrease, here your equity increase. Overall impact is 0. Equity increase due to capital, reserve decrease. Due to reserves, equity decrease. Due to stated capital, equity increase. The overall impact is 0. Owner's equity also no impact or no change. No impact or no change. Due to rights issue, equity increase, cash flow also increase. Due to capitalization, no change in equity or no impact, no change in cash flow also. We don't get cash from a capitalization. For 26 and 27, the cash paid for purchases collected from customers, expenses paid, right? And the cash purchases is a part of your operating activities, operating outflows. The cash collected from customers, operating inflow, expense paid, all these cash flows are operating cash flows. The cash balance 1st of January and 31st January, 1st of January opening, 31st January closing. Investment in 3 months treasury bills. Investment in 3 months treasury bills, part of your cash equivalent, opening, closing balances. The opening and closing balances. What is the net increase or decrease in cash and cash equivalent? Net increase or decrease during a period. Right. And to calculate net increase or decrease, we can use net operating plus net investing plus net financing. To identify the net change, net increase or decrease, we call net change. Net change. Operating, investing, financing. Net operating, net investing, net financing. Or closing cash and cash equivalent minus opening cash and cash equivalent. Closing cash and cash equivalent minus opening cash and cash equivalent. So if you go back to the question, you have operating activities only. Operating activities only, and the closing opening balances are given. Closing opening balances given. Then the first method is not possible. According to the information given in the question, first method is not possible. Then we can use the second method. Closing cash and cash equivalent minus opening cash and cash equivalent. Closing minus opening, the closing cash and cash equivalent minus opening cash and cash equivalent. Closing minus opening. The closing information. Here you have closing 31st January, treasury bills and cash. You take the addition. You have cash balance of 40 million, treasury bills balance of 50 million. Altogether, closing you have 90 million rupees. The closing 90 million rupees. In the opening cash you have 50 million rupees. Treasury bills you have 100 million rupees. So altogether 150 million. Opening date you have cash 50 million, treasury bills you have 100 million, altogether 150 million. Opening balances. Again, closing, opening. Opening balances. This is closing balances. Then the net change equal closing minus opening, you get minus 60 million. Minus 60 million. Treasury bills is a part of your cash equivalent. Treasury bills a part of your cash equivalent. So the answer is question, net increase or decrease, you get minus 60 million, that is minus 60 million. to minus 60 million, net increase or decrease, you get 60 million rupees. $60 million decrease. How you got? Closing cash and cash equivalent minus opening cash and cash equivalent. The 60 million decrease. The 60 million decrease. So, what is the total of net cash flows from both investing and financing? From both investing and financing. Right. And the net change. The net change equal net operating, net investing, net financing. The cash flow net change equal net operating, net investing, net financing. The question requirement is what? What's the total of net cash flows from both? From both investing and financing. From both investing and financing. Say it's x, so what is the value of x? What's the value of x? The net change. Net change we calculated minus 60. So you can use minus 60 net change is 60. Then if you know the operating cash flows, you can calculate the missing value of x. So here operating, investing. But this cash paid for purchases, operating outflow 50. Operating outflow 50. The cash collected from customers, operating inflow 120. Operating inflow 120. Then the expenses paid, operating outflow of 50. The outflow of 35. Operating outflow of 35. Outflow, inflow, outflow. Outflow 50, inflow 120, expense paid, outflow of 35. Then you can take net operating cash flow. Net operating cash flow. Minus 50 to minus 50 plus 120 minus 35. You get plus 35. You get plus 35. 35 million net operating cash flows plus 35 million net operating cash flows plus. Then you can go to the calculations. You calculate net operating, how much you got? 35. 5. Then to x equal minus 95 million. X equal minus 95 million. Now what's the answer? X mean what? Our both investing financing. X mean both our investing and financing. 95 million decrease to 95 million decrease. Then what's the answer? What's the answer? 95 million decrease. We get a 95 million decrease. The 95 million rupees decrease. The net profit for the year, the profit for the year is given. Depreciation, disposal loss, increase in working capital. Increase in working capital. And the working capital means current assets minus current liabilities. The working capital means current assets minus current liabilities. The increase in working capital. To get this value increase amount, either current assets should increase or current liabilities should decrease. The current assets increase mean cash outflow. Current liability increase mean also cash outflow. Both are cash outflows. The working capital increase mean cash outflow. To calculate the value of net cash flows from operating activities. Net cash flows from operating activities. We have same calculation sheet you can use for that. The net profit for this given as 70,600. The net profit for this 70,600. $70,600. The depreciation is a non-cash item. Depreciation, non-cash item, we have already deducted from the profit. We have to add it back. Depreciation how much? 20,100. The depreciation 20,100. The machinery disposal loss. Depreciation we considered. Machinery disposal loss. The disposal of assets, machinery is non-current assets. Invest in activity, here you have a disposal loss. The disposal loss has been deducted. The disposal loss has been deducted. $1,900 in the computation of profit. We have to add it back. Then the increase in working capital. Working capital increase. Working capital increase due to increase in current assets or decrease in current liabilities. Its amount 14,300. Both are cash. Current assets increase, cash outflow. Current liabilities decrease, cash outflow. It says working capital increase. Increase in working capital 14,300 cash outflow. $692 to know information on tax and interest can get the net cash flow. ₹78,300,000. 78,300,000 rupees is the answer. You got the profit and adjusted for depreciation and disposal loss. And the working capital increase, cash outflow you deducted 78 to 78,300,000 rupees. The answer 78,300,000 rupees. 78,300,000 rupees. So the summarized income statement is given. Gross profit, disposal gain, expenses including depreciation, special expense for the cash flow, and loss on sale of office equipment. Disposal loss. Then the disposal gain is an adjustment. Depreciation also an adjustment. Disposal loss also an adjustment. Here we have adjustment, disposal loss, disposal gain, and depreciation. The tax expense and the profit for the year. The profit for the year means the final value after deducting tax, interest, everything. So during the year, the balances of following items have decreased. The following items, the balance of following items decrease. The inventories decrease mean cash inflow. Inventory decrease, cash inflow. The trade receivables decrease. Again cash inflow. The trade payables also decrease. Trade payables decrease mean liabilities decrease. The liabilities decrease mean cash outflow. These two inflows, they have decreased. This is an outflow. The income tax paid for the year 40,000. Net cash flows from operating activities. We'll make our calculations. With the profit you start and you end up with cash flows. The profit for the year is given. The profit for the year is given. Profit for the year is given. This is for the year profit, that is after tax. So here we take profit before tax. The profit for the year, how much given? 300. How much is the tax expense? Tax expense given as 50. Then you can add your tax expense to get 350 profit before tax. 350 profit before tax. Gross profit given. Disposal gain from motor vehicle. Disposal gain. And so here the gross profit is not important. Why? We make the adjustment from the net profit. Disposal gain. So disposal is a investment activity. It's an investment activity. Disposal gain. This gain we have recorded in the profit. It includes in this profit. Then under adjustments, you minus your disposal gain. Disposal gain of how much? 30. Disposal gain, you minus 30. Now the expenses including depreciation. Expenses including depreciation. The depreciation also adjustment. Depreciation is an adjustment. How much? 40,000. That we have to add. Why? In the profit computation, depreciation we have deducted. We have to add it back. Depreciation of 40,000. And loss of sale of office equipment, disposal loss. So disposal loss we have deducted in the profit. Disposal loss we have deducted, we have to add it back. Disposal loss how much? 20,000. Disposal loss 20,000. Disposal loss 20,000 rupees. And during the year, the balance of following items have decreased. These balances decrease. The inventory decrease mean cash inflow. You have sold. Working capital changes. The working capital changes. Decrease in inventory. The decrease in inventory, how much is it? 130. 130. Right. Decrease in trade receivable. Trade receivable decrease mean your debtors they have paid you. They have paid you. You add cash inflow. Decrease in trade receivables. So how much? 110. 110. Cash inflow. And the trade payables. Trade payables decrease. It says decrease. Trade payable decrease mean cash outflow. You have paid them. Cash outflow, you have paid them. The decrease in trade payable. Decrease in trade payable, how much is it? 150. Cash outflow 150. What's the question requirement? Question is net cash flows from operating activities, net operating. Then you have to minus tax payment. The tax payment how much? The tax paid is given as 40,000 rupees. So you get the total here 380. $90 plus 470 minus 40, 430. You calculated profit before tax. For the profit, we added tax. Then we made adjustments for 3 items: disposal gain, depreciation and disposal. Working capital changes, inventories, receivables. These balances is clearly say decrease. As decrease your cash inflows, but trade payable decrease mean cash outflow. Tax payment you minus. The 430,000 is the answer. 430,000 is the answer. The question is, what was the net cash flows? Answer is 430,000 rupees. Answer is 430,000 rupees. Answer 430,000 rupees. Here sometimes you says clearly decrease. The 30th question, a company which was formed on these days reported a profit of 250,000 rupees. A profit of 250,000 rupees. Assets consist of machineries cost 1 million, carrying amount 900,000 mean you have a depreciation of 100,000. Depreciation of 100,000. Inventories. It's a newly started company. Inventories increase mean inventories increase. Cash outflow. Cash outflow by newly started company. Cash and bank increase. Treasury bills. These two, cash and bank and treasury bills, is a part of your cash and cash equivalent. Part of your cash and cash equivalent at the end. The receivables increase. Why you say increase? Is newly formed company increase. Cash outflow. The trade payables, liabilities increase. Cash inflow. Cash inflow. Those are the details what was the net cash generated from operation activities? Net cash flows from operating activities. Okay. And you can use the same the calculation sheet we use to calculate the net cash flows from operating activities. The profit is given as 250,000. Profit is 250,000. The profit is given as 250,000 rupees. This is the profit. The profit is 250,000 rupees. And the items given, machineries cost 1000 has now become 900. The depreciation 100,000. Depreciation is an adjustment 100,000. Depreciation 100,000. Then inventory. The inventory opening balance 0, newly started business. Inventories increase mean cash outflow. The inventories mean cash. The inventories opening balance. No opening balance, newly started company. The inventories increase cash outflow. Cash outflow. Working capital changes. The working capital changes. Increase in inventories. How much? 400 cash outflow. So newly commenced business, inventories increase mean cash outflow. Then the cash and bank and the treasury bills. So these two are part of your cash and cash equivalent. These two are part of your cash and cash equivalent. Then the trade receivables. The trade receivables increase cash outflow. How much? 340. Increase in trade receivables. 340 cash outflow. 340,000 cash outflow. The trade payables, creditors. The creditors increase cash outflow. Creditors increase cash outflow. Increase in creditors. The increase in creditors increase mean cash inflow. Cash inflow. You haven't settled them, cash inflow. Increase in trade payables, 360,000 rupees. So these are the information available. All information we considered. You can get the total. 250 plus 100, 350. To minus, to get negative 30,000. The answer is the negative 30,000 rupees. What was the net cash flows generated from operation activities? 30,000 net cash outflow. 30,000 net cash outflows. Indicate whether each of the statements given in the table below true or false. Right. The first one, statement of cash flows is more reliable than the statement of profit or loss. Right. Amta, you have mainly 5 components of financial statements. You have mainly 5 components of financial statement. The statement of profit or loss and other comprehensive income, the statement of financial position, statement of changes in equity, and statement of cash flows plus accounting notes and policies. Right. So out of this financial statement, this is only the financial statement you prepare on cash basis. Cash basis. Statement of profit or loss, accrual basis. And the accrual basis, sometimes the credit sales you record. The later on, due to higher amount of credit sales, you can have a higher amount of profit. But in the future, sometimes you may not be able to collect it. Then, whatever the profit you calculated this year is not accurate. But the statement of cash flows, the statement of cash flows, it shows accurately. It shows accurately how much you have received and how much you have paid, inflows and outflows. And then statement of cash flow is more reliable than the profit or loss. It shows how you received cash and how you cash generated and cash used. Statement is correct. It's more reliable. The net cash flows generated from operate necessarily imply that cash generated from operations necessarily imply that an entity has certainly earned a profit. The statement says, now say example, say cash profit, cash flows generated from operating activities. We have operating, investing, financing. Say operating activities, you have 25 million, say 2,500,000. What the statement says, this 2,500,000 net operating cash flows shows the profit. No. Why? The profit calculation is on accrual basis. Profit calculation on accrual basis. Operating cash flows only cash basis. Operating cash flows on cash basis, but profit calculation on accrual basis. Take depreciation. The depreciation you consider it in the accrual basis, but cash basis we don't consider. Depreciation you consider on accrual basis profit, but cash flows we don't consider. Another example, Puta, investment income. Investment income, accrual basis profit you consider, but net operating cash flows we don't consider. Why? Investment income is an investing activity. Investment income is an investing activity. So then statement false. Your profit doesn't show that you're operating cash flows. The next one, the value of the bonus share issue is shown in the statement of cash flows as cash inflow. Now, I think we discussed in the previous question, bonus issues, capitalization the capitalization was a double entry. When you capitalize reserves, double entry, the reserves account debit, stated ordinary share capital account credit. Reserve account debit, stated ordinary share capital account credit. It has no cash involvement. If you again consider double entry, cash is not involved, no cash entry. Statement, the value of bonus shares is shown in the statement of cash flows. No, it is not a cash transaction. It's not a cash transaction. The statement of cash flows summarizes future cash flows. The statement of cash flows you prepare on historical basis for the year ended. These components of financial statement for the year ended financial accounting. It says future, it's not future, for the year ended past. Statement false. The statement of cash flow is more reliable. Yes, true. Net cash flow generated from operations shows that company has earned a profit. No. Accrual basis and cash basis. The value of bonus issues, we don't show the bonus issue. It's not a cash transaction. Cash flow summarize past for the year ended. Right. That was the cash flow summary. This was the cash flow summary. Company account question, company account lesson, you get this cash flow as a separate part of a question plus in the MCQ paper also. Right. In the step by step, we have covered certain areas in the syllabus now. Right. Step by step, we have mainly concerned main areas in the exam paper. So today we discuss LK7 cash flows. Here you should know definition, cash, the cash equivalent, cash flows, operating activities, investing activities, or financing activities. And to present the cash flow, we have two methods. Based on how you present operating cash flows, you have two methods, direct method and indirect method. And we discuss questions covering both. Right. And then under the program of NanaJaya, the Bank of Ceylon comes to you with main areas in the syllabus under different topics. I'm also lucky to be a part of this program initiated by the Bank of Ceylon, Bankers to the Nation. And this Bank of Ceylon will be happy if you get something from this seminar series. To staying at home, you can practice this. I have given sufficient time to the question. You can first do and recheck with my answers. As the organizer, Bank of Ceylon will be very happy as you are our future if you get some benefits from this series of seminars. Until we meet another topic, we will the lessons today and we'll meet with a new lesson. Thank you very much for your support, and again thank you very much to Bank of Ceylon for inviting me to conduct this lesson. Ayuban.